Hey everyone, and welcome back to my channel. Today we're diving into a crucial concept that impacts every single one of us when it comes to our money: the risk effect. Understanding this isn't just about investing, it's about smart financial decisions that align with your comfort level and your goals. So grab a coffee because we're breaking down safety, growth, and that sweet spot in between. Let's start with what most people are familiar with: accounts that prioritize safety above all else. Think about your traditional savings accounts, checking accounts, and even some certificates of deposits or CDs. These accounts are fantastic for your emergency fund. They're typically FDIC insured, meaning the government backs your money up to a certain limit. You can sleep soundly knowing your principal is almost entirely protected from market fluctuations. The downside? Well, that safety comes at a cost. Your money won't grow significantly. In fact, with inflation, the purchasing power of your money in these accounts might even decrease over time. They offer security and liquidity, but very little in the way of wealth building for the long term. They're like wearing a helmet and knee pads for a leisurely stroll. Super safe, but not designed for speed or adventure. Now let's swing to the opposite side of the spectrum: accounts directly influenced by the stock market. We're talking about individual stocks, mutual funds, or exchange-traded funds, often held within brokerage accounts or retirement plans like 401ks or IRAs. Here, the potential for growth can be substantial. If the market performs well, your investments can see significant returns, potentially outpacing inflation and helping build serious wealth. This is where you put your money when you don't need it for a long time: 5, 10, 20 years or more. However, and this is a big however, these accounts come with absolutely no safety net from market downturns. When the market drops, so does the value of your investments. You could lose a significant portion or even all of your principal. It's like extreme sports: exhilarating potential, but high risk. You need to have a stomach for volatility and a long-term perspective to ride out the inevitable ups and downs. So, if one side is super safe but slow, and the other side is fast but risky, is there a middle ground? Absolutely. And one of the most interesting options to explore are indexed accounts, often found in products like fixed index annuities or index universal life insurance policies. These accounts aim to give you some of the market growth potential, but with a crucial layer of protection against market losses. How do they do this? They track the performance of the market index, like the S&P 500. When the index goes up, your account participates in that growth, usually up to a certain cap rate or participation rate. But here's the magic: when the market goes down, your account typically has a floor, often between 0 and 1%. This means you won't lose any money due to market declines. You get a portion of the upside with protection from the downside. It's like going hiking with a safety harness. You still get to climb, but you're protected from falling. This makes index accounts a compelling option for those who want more growth than a traditional savings account, but aren't comfortable with full market risk or direct stock market investments. They offer a balance, aiming to provide growth potential with safeguarding your principal from market volatility. Understanding the risk effect and the different types of accounts available is foundational to building a solid financial plan. Whether you prioritize safety, aim for aggressive growth, or seek that balanced approach with index accounts, the best choice is always the one that aligns with your personal financial goals and your comfort with risk. So, what's your go-to account type? Let me know in the comments below. Don't forget to like this video, subscribe for more financial insights, hit that notification bell so you don't miss our next upload. Thanks for watching, and I'll see you next time.